Welcome to Chew the Fat. I am your host, Smoove, and today we have a couple of very special guests with us. Please show them some respect here today. I got some serious value going on today. I hope you are ready to receive the information that we are going to give you today. Some of you may recognize my good friend here on my left. We have ourselves Cuban Jay. You may recognize him from the 95 series. He's visited the station a time or two. And go ahead and tell them a little bit about yourself for those who may not remember.
Hey, I'm Cuban Jay. You've seen me on 95 and barbershops on Cut East Coast. And a lot of people come up to me and say, Cuban, what do I do with my money? So,
How about that?
you can give it to me. So I said, let me bring my boy Michael, and you guys know what I do with my money, what you can do with yours.
Absolutely. So that brings us to our next very special guest. We will let them introduce themselves and tell you a little bit about them. Go ahead, let us know who you are.
Yeah, my name is Michael Rothfuss, financial advisor, and I have my own independent financial advisory practice called Bell Retirement Strategies. You can go to bellretirementstrategies.com to learn more. And yeah, I'm here today to talk some money.
How about that? How about that? And money, we will talk. We're not going to waste any time. Anybody who is here, please do like the channel, subscribe to the channel. We will also leave all of Mike's information in the description. I would encourage you to reach out to this person. I would encourage you to check out their videos that they have as well. They are offering some serious value and you don't want to miss out on it. And you'll see why in just a few moments. Nice. So now, one of the things that we are very much afraid of, right? Cuban Jay, you know what I'm talking about, right? We run a relationship channel on this side, right? So a lot of people are concerned about relationships and money and how they correlate. It's a very scary thing, and the scariest thing about marriage that most of us don't like to admit is the money. We are scared about our money, and we should be. We should be mindful of our money, and we should know what to do, how to get into this situation as far as what to do with your money. We are scared about that. How do you feel about that?
Well, I mean, I often get, I just met a girl and she wants us to pool our money together. For those guys out there, Michael, should they put their money together?
Yeah, this is a very personal question. I don't think any financial advisor is going to be able to tell you how you should handle your money as a household. I think this is a personal decision that couples need to be upfront and transparent and talk to each other about. Ideally before you tie the knot, right?
Right.
Because if not, then you're going to be not just splitting your money, but the state and some lawyers are going to be splitting up.
Tell them.
So, over my career of 20 years, I have met with couples that completely combine everything together. Their savings are together, their spending is together, their income is together. It's all in one bucket. And that's okay. It works very well. And at the other end of the spectrum, I've also seen, couples that could do things completely separate. And that's okay as well. I've met with people where they're about to retire and they're looking to have a financial plan be put in place. And I ask about the spouse. And they're like, oh, she or he does their own thing. And that's completely fine. A lot of times they'll have their own financial advisor. And that works if that is the understanding between the two couples. So I think it's just important that couples are open and honest about that. My personal relationship with my marriage, we combine everything. My wife is a Philadelphia school teacher, and what's hers is mine, mine is hers. That's how we do it. But there's nothing wrong with other couples doing things completely separate as long as that's the understanding and completely understood going into the marriage.
So, a lot of times, you're working 9 to 5, you have some money left over, you have your business, you have some money left over. What are some ways for somebody to get started in investing with some of that extra change?
Yeah, I think there's an orders of operations if you're looking to get started. And, at the very beginning, I think if you have an employer-sponsored plan, ideally one that matches, then before you do anything else, find a way to contribute up to the employer match.
I mean, like a 401k?
Yeah, so a 401k is an example. There's other employer-sponsored plans like 403bs if you're in the a public sector nonprofit, and 457 if you do work for the public sector. And you want to take advantage of at least that company match because it's free money, right? If after that, then the next thing I would worry about in the orders of operations here is paying down high interest rate debt.
Ooh, that's like your credit card.
That's exactly
That's the main. They have the highest interest in the
it's like
20s, right?
30% or something like that.
Yeah,
It's crazy.
20s. Yeah, it's
So-
bad.
Personal loans?
This is something you got to tackle, so let's say if there's ways to do this. If I'm helping someone eliminate their debt, there's no magic pill to this. All right, there's no way of just magic wand and going, all right, let's reconsolidate or anything like that. Unless it was like when interest rates were low, you can you can consolidate that into a refinance of the mortgage. That's not really an option anymore either because interest rates are higher.
Yes.
So let's say you have 5 different credit card balances, all with different interest rates, different minimum payments, different balances. I would help someone by let's just first laying out on a list and laying them all down, balances, interest rate, minimum payments, and prioritizing. You can prioritize this in one of 2 ways. You can list this on the top being go after and target first the highest interest rates of balances first, or you can target the smallest balance first. Now, statistically, paying down the highest interest rates are going to get you out of debt quicker.
Right.
But sometimes you just need a win. So the way you do this, I've talked to some people before, they're like, well, I pay a little bit extra to all the balances. And that's a surefire way to pay a little bit extra for a much longer period of time.
Right.
Pay all the 5 balances in this example, the minimum of payment that they ask for, and then every extra dollar that you can come up with, apply it to the balance next on your list, whether that's the highest interest rate or the smallest balance.
Okay.
Like I said, the highest interest rate makes more mathematical sense, but if sometimes you just need that psychological win, right? You want to kill that
Got rid of
first
something.
debt.
Yeah.
Get rid of the smallest debt.
That's right. Kill the first one off. Then you got everything you were paying towards that one applied to the next one on the list.
Yeah.
And it starts snowballing. And then you do it again and you apply it. Before you know it, you're down to that 5th balance, and maybe that's the largest balance, or maybe that's, and if it's the largest balance, you now have everything you were putting on to the other 4 and now applying it down to just this one, and it snowballs. And that's the
It takes a little bit of discipline. I mean, because while you're doing that, you have to make sure you're still not spending.
Absolutely, because you're
Spending
going to be doing
is what got you into the credit card debt. So I think the very first thing you need to do is budget and
minimize
Exactly.
expenses.
Yeah.
Absolutely.
Yeah,
minimize
know where your money's going, so you can make those, informed, aware decisions of like where you want to spend and where you don't, where you think you can cut, and then you can only do that when you identify it. But once you get rid of the debt, I think the next thing you want to do is build up an emergency fund, because life happens, right? You may need new appliances. You might need but life always tends to find a way to need a few $1,000s here and there.
Now, what I do want to ask about that, because all of us have different kinds of budgets. So I guess there would be a formula as far as based on percentages. Would you say someone should probably have how much percent of their income or how much of months living expenses would you advise somebody to have in an emergency fund?
I think 3 to 6 months is a good,
Okay.
somewhere between 3 to 6 months, because it not only, keeps you from, going into debt again for if something happens and
Right.
you need to fix
Flat tire or something,
flat
yeah.
tires, car repairs.
Yeah.
But what if something happens and you don't have a disability policy through work? You're out of work for a few months. You gotta get by, and so
Nah,
that's why. You're
That's
not
tough.
investing in
That's
this
tough.
emergency fund. You're just putting it into now. Money markets can pay a little extra.
Now, this is something that most people don't talk about because they get right into the 401k. But the current bills that you have that you can't pay off, your car insurance, right? Home insurance for those that own homes, renter's insurance, your cell phone, even your internet connection, to find the lowest possible way of obtaining that service. And start saving money and not just giving it away, and finding a service that, for example, will give you the same ability to have For example, a cell phone. Why go with a subscriber that's much higher when you can find a more budget subscriber, save some money there, use that savings to help pay some of that lower balance for that one win.
Yeah, that's
Right?
one way.
You still have your cell phone,
Absolutely.
right? It may be from another company, but at least you have cell phone service and you're saving, right? You have a lower auto insurance policy.
Yeah, and a lot of people sleep on a savings, but I'm going to tell you, a lot of people will say a money saved is a money earned, right? A dollar saved is a dollar earned.
Yeah.
Or a penny saved is a penny earned.
Used to be a
However
penny,
you want to
yeah.
put it.
Used to be another.
Yeah.
Or you see a penny, you don't even pick it up
inflation
anymore.
is-
Dollars not much anymore.
A lot of us, what's that? What's that?
Change. What's change?
So, I'll tell you what I do personally. There are some things that I do. Like I shop right. I'm not going to say the specific supermarket, but what I do is you can get a club card or whatever, right? If you have children, then sometimes it's better to go to a wholesale place, but not always. If you know how to clip the coupons, you can clip coupons, right? Me or maybe my wife might clip coupons, or some people allow you to have digital coupons. I'm more of a digital coupon guy. I can't sit there with the scissors and do all of that, but I will say, hey, let me see what digital coupons are in here before. Oh, okay, I do buy this, I do buy this, I do. And sometimes it's tedious, but I'm really going to take about 1 or 2 minutes to do it. And if I can save about $20, that's more than I make in that time. So that's how you have to think about it. Don't say I don't want to be bothered with it, but if I'm going to save $20 in 2 minutes by pushing a couple buttons to say, look, this, I know I buy this, I know I buy this, I know I buy this. Most of us aren't making $20 in 2 minutes. Some of us are, okay, great, but most of us are not, right? Statistically, no. So if you can take the time to do something as simple as that, and looking for the times where certain things are on sale, and then just bulking up on things that are non-perishable, that also helps. So, and some things you can get away with things that are not name brand, right? There's a lot of alternatives that I would say you should look for.
Generic kind of.
Yeah,
Is that what you're saying?
and it's tough for me to do that on food because I'm like a food buff.
Hey, some people may have to do it on food.
And sometimes you have to.
You know.
Exactly. And as far as meats, when you go to your regular supermarkets, meats are way more expensive than if you went to a space that sold meat specifically, or a produce mart specifically. You'd find that your goods are cheaper, right? Even with your clothes, right? You can buy a lot of clothes. There's things that people just don't know about, like sometimes you can hit the outlet stores if you must have the brands, because some people are just not going to be seen without the brands. If you're not rich, then you're probably wild for doing that, but if you must, there are wholesale places there. Even people don't even know. Just for instance, Nordstrom has the Nordstrom rack, right? And I don't want to name brand anything or whatever, but yeah, you know that you can still find a lot of things there that are name brand, right? You're not going to see everything, because you're not going to find everything there, because certain things will dispose of their clothes because they don't want the peasants to wear it, right? But it is what it is. A lot of the clothes are available there. You can go to a lot of these smaller stores, outlet stores. Nike has outlet stores, everything. So there's different ways to save money. Me personally, I would suggest you shop at a place like or Marshalls or something where you can get a lot of your mid-range stuff that is still going to be very good quality, like you paid money for it, but not necessarily those top-tier brands.
And tell these women, if you're struggling, stop having more kids.
Ooh.
Stop having more kids.
How about that?
Listen, I would say that that's part of it, right? You should, and this goes back to the relationships we were talking about. If you as a husband and a wife, you have to manage that, right? So it's very important for you to understand what it is that you can have. I knew for a fact that I was going to stop at 2, and I did, because I'm like, nope, that's it, 2. Me and my wife agreed upon it, right? But we already knew.
You
that.
actually sat down.
Yeah, this is stuff you talk about before you get married, because I'm going to stick to my guns.
Did you do that, Mike?
Yeah, absolutely.
Yeah, we have to be on the same page. We said 1 or 2,
same page.
and we're like, we're not.
That's it, right?
Yeah, that's it.
We're gonna stop here.
And we're gonna do something to make sure that that's it. Yeah, it's not to just say
It's
that's
expensive
it.
having kids, right?
And I'm just gonna tell you, most employers will pay for you to have that kind of a surgery that is preventative, right? They won't hook you back up. No way. Good luck getting them to cover that. But they will, obviously, because it's an investment to many companies to say, hey, look, so wait a minute, you mean you want to have a surgery? That means we won't have any more dependents? Awesome. They are so for that. They are like, hey, look, okay, great. You're not going to have any more kids ever? Great. You sure will pay for it. So You know, these are just options, and I'm not against children, but I am certainly against having more children than you can maintain,
Right.
for sure. Because it's not just the financial aspect; it's also the can you spend quality time with them as well.
And the quality of life, too.
Exactly.
Yeah.
Exactly.
So, I mean, you got your taxes done, did you?
Yeah.
Yeah.
Speaking of taxes, what are some?
Tax hacks.
You have any for us?
Yeah, we can talk
What are
about
the
tax.
top three? Give me some
I'm
top
not
three.
a tax. I'm not. A
He
tax,
was a tax hacker, huh?
I'm not a certified public accountant. So,
Gotcha.
You know, I have to. There's a limit on what I can talk about, but I do tax planning strategies with people utilizing things like whole life insurance or Roth accounts, and I'll talk about one little loophole that a couple
Okay.
loopholes.
Okay.
The
What you got?
backdoor Roth contribution.
What's that? What's that for those that don't know what a backdoor Roth is?
So a backdoor, the IRS doesn't want high income earners to contribute to a Roth IRA. I think the
Which is
limits
another
are-
form of retirement, right? Or retirement.
a retirement account,
Doesn't
Roth
know
IRA. And so, you know, the IRS puts limits. They start phasing out the ability to contribute to a Roth, a Roth IRA. I believe it's if you're a single filer, 116,000 if you make your adjusted gross income, or if you're married filing jointly, if you make over 218,000, I think the limits are this year. They start phasing out the ability to contribute to a Roth IRA. But what you can do here, and the way the high earners get around this, is you can always contribute to a traditional IRA. Now, it might not be deductible, especially if you're contributing, participating in an employer-sponsored plan, because the deductibility limits make it harder for that to be deductible. But even if it's not a deductible traditional contribution,
Right.
that's okay. Get the money in the traditional IRA, because interestingly enough, the IRS, even though they have limits on who can contribute directly to a Roth IRA, there's no limits on how much you can convert to a Roth IRA. So once the money's in, the way this backdoor Roth works is once the money's into the non-deductible, and in our example here is in the traditional IRA, through a separate transaction, you convert that over to a Roth IRA, and now you got the money in there into the Roth IRA. And so that's how a lot of high earners are utilizing a way to get money into Roth, because the power of the Roth is, there's rules in place, but you put the money in after tax, and then over time, it potentially can grow, right? With investments can grow. And when you eventually take the money out, as long as the money's in there for 5 years and you're over the age of 59 and a half, it'll come out 100% federally tax free.
All right, now wait, slow down. Now, for those guys that are like, what are you talking about? Roth IRA and traditional IRA.
So let's just say I make $100,000
And I put 66,000
Mm-hmm.
into a Roth IRA. That means that when I do my taxes, I'm only going to get taxed on 94,000.
That's right.
Yeah.
Because it's deductible.
It's deductible. That's a Roth IRA.
Yeah.
Now a traditional, I can make the same 100,000.
Oh wait, you were talking about the Roth IRA. I thought you were talking about traditional. Okay. So traditional is deductible.
So the traditional is the
Traditional
one where I put
typically
6,000 in,
deductible.
and it takes. So now I'm paying taxes on 94,000.
That's right.
Not the 100,000
That's right.
because I put 6,000 into the traditional IRA.
Yeah. And so when the money eventually comes out, when you're over the age of 59 and a half in the traditional IRA, it's taxable in retirement.
Right. Now the Roth IRA,
Mm-hmm.
I'm going to get taxed on 100,000, but I'm putting 6,000 after tax into this Roth IRA. And when I retire, I don't pay taxes on that.
No, yeah.
Okay.
You've already paid your taxes up
You already
front.
paid it
You
up
pay
front.
the taxes. Where the power is, though, is you're getting a break on the growth,
Absolutely.
right? So
Absolutely.
if you have a long time now, that's assuming that the investments grow, because not every
Right.
investment
So
returns.
the dividends on that, they don't get taxed.
That's right.
And when you retire,
When you take the distribution out in retirement, they're not
they're not taxed.
it's tax-free
It's
income
tax-free
in
income.
retirement. Yeah.
Okay.
So this is why high earners want to get this money and utilize this backdoor Roth strategy by getting money into the Roth so that they have a tax-free income stream in retirement. That's basically the synopsis of how.
Now there's a limit to what you can put into the Roth.
Yeah. Both traditional and Roth IRAs. This year you can put up to, I think it's 7,000, 7,500. They change it every year.
Yeah, I think it's
6,500.
It was last year.
and then
yeah.
if you're 50,
And
it's
if you're over,
7,000.
if you're over 50, you can put an extra $1,000.
Right.
Yeah.
Oh wow.
So now we have a difference.
So
there.
you got
Roth,
a little cap on it. Okay.
Now
traditional.
there's also a a mega backdoor Roth.
Whoa.
Ooh,
Backdoor.
Wait. I
What?
kind of like the way that sounds.
Yeah, and you know, like the backdoor Roth. The backdoor Roth sounds like it's a loophole thing, right? And so the way to mega backdoor is so for your 401k. We were just talking about contribution limits to IRAs. Now 401ks have contribution limits that go all the way up to $27,500 for this year. And if you're over the age of 50, you can put an extra $7,500 into as a catch-up contribution. But if you want to put more after that, if your employer 401k plan allows you to put after-tax dollars into the 401k, not every one, not every plan, because every plan is different. Every plan has their own set of rules. But if the plan allows you to put after-tax dollars in, you can build up that bucket from $27,500 all the way up with after-tax dollars to $66,000 with the after-tax money. The after-tax looks a lot like Roth, but it's not growing, tax-free. But when you separate from service, you tell your administrator when you separate from service that I want to, they'll send you two checks. They'll send you a check for the before tax that you roll over into a traditional IRA, and they'll send you the after-tax, which you can put. And if you have a significant amount built up, you can get a significant amount of money into a Roth IRA that way, utilizing the after-tax mega backdoor strategy. So that's another one.
So I'm making 200,000, right?
I put in, my company matches 6%.
Mm-hmm.
And now you're saying I can add after-tax money up to, let's just say the maximum they allow me is 25% of my salary.
Yeah, well, the company, the 25% or up to $27,500.
Up to $27,500. So now I do my taxes.
If you're over 50, tack on another $7,500 that you can put.
Okay.
And now you're doing your taxes. Now maybe you want to put more.
Up to $66,000.
Yeah.
So now I'm making that $200,000 mark. You're subtracting $66,000, and that's what I'm going to be paying taxes on.
The $66,000, up to that point,
Right. That's the most that
it's
I
after
could.
tax. Well, you already pay taxes on it, so you don't have to pay.
Right.
tax.
That's right. It's after tax.
So it's after tax.
Yeah.
So and that's why since it's after tax, you can just get it into that Roth when you separate from service. And you have to do this when you separate from service, though. So make it a clean rollover. So there's no. Sometimes they do the pro rata where they mix and commingle these after tax funds, and that's the way the IRS, used to keep people from doing this strategy. But they finally gave up because too many plan administrators were just sending the after-tax dollars, directly with a separate check, and people were rolling it over into a Roth, and they eventually gave up, and they're like, all right, through different notices, they're like, we're going to allow this.
Okay.
So those are two strategies, kind of loopholes that, I guess you use loopholes, you use that word very loosely, but these are ways that high earners, utilize the tax code and get money into Roth IRAs. But let's talk about maybe if you're not a high earner. What if you're someone that is just starting early in your career and you want to start saving? Of course, again, take advantage of that employer match first and foremost. But the IRS has a retirement savers credit.
Okay.
People
Retirement savers credit?
For lower income earners that they consider lower income, and those limits are if you make less than $36,500 as a single filer, or if you make less than $73,000 as a married filing jointly, you can put up to $1,000 as a single filer, or you can receive up to $1,000 in a tax credit from the IRS as a single filer, or up to $2,000 as a married filing jointly file. And this is IRS is gifting this to you in the form of a tax credit. So that's something that a lower income earner can take advantage of in the tax code to help out with their savings, and it's the retirement savers credit.
So how do they do that? How do they go about doing that?
And you have a good CPA. Well, they probably don't have a CPA, but even if you use TurboTax, they'll ask questions. They ask a number of questions, and when you file your taxes, they'll know your adjusted gross income and that you qualify for that credit.
Oh, okay. So that's kind of done by the tax professional, right?
Mm-hmm.
All right.
Yeah.
For those of you out there, stop buying those kids for those tax deductions. Hit that $1,000 credit.
Child credit tax. Yeah.
Now,
I was going to mention one more.
Okay, go ahead.
So what you got?
Real estate.
What you got?
Yeah,
So
'cause I
real
was
estate
just-
is unique. Why maybe real estate is unique and why it makes a good investment. And I don't advise real estate in my practice, but what I find unique about real estate is that if you are considered by the IRS to materially participate in real estate activities, you have the ability to basically, take a piece of property and depreciate it over time.
Yeah.
Maybe sometimes faster than others, but like depending, I'm not a tax expert, but what's interesting though, you can depreciate a property while at the same time or actually maybe appreciate it. And so I think that's unique to real estate. And again, when you want to see a good CPA, certified public accountant, for these strategies, when it talks to
You got anybody you recommend?
no, I'm looking for one actually to team up.
Come see my dad.
So yeah, I'm looking for someone who has a solo practice.
Okay.
I think, it's a good partnership with a financial advisor, so we can do these types of things together. Because I can, they could do things that I can't, and I can do things that they can't. So
Team
But
No,
together you can
Teamwork makes
do
the dream work.
everything.
definitely looking for one to partner with.
Now, I got a pretty decent one here. So there
What you
are
got,
some
Trey?
people. There are some people who we take our life insurance policies, which we should, in the event that anything was to happen to you,
Yeah.
or your spouse, or you want them to be taken care of, right?
Mm-hmm.
So there are some people who would want to know, what do you think is good, bad, or ugly about borrowing against the cash value and a whole life insurance policy?
Yeah, so for our listeners, let's first talk about, because there's also term life insurance versus whole life insurance.
Right.
So term life insurance first, let's talk about the differences between the two.
Okay.
Term life insurance works really well for someone who's, in their peak earning years, and they want to be able to protect their family, and they're the breadwinner perhaps. They want to protect their family from the sudden loss of the household income from an untimely death. And term life insurance will definitely have much lower premium. It's cheaper. It's a cheaper alternative to whole life insurance, and works great because it's a pure form of insurance. You're insuring the fact that you might lose that income from an untimely death. Both whole life and term life insurance will pay a tax-free death benefit, though, to your beneficiary at the time that the policyholder passes away.
Tax free.
Yeah,
Wow.
and so
You don't hear that often.
Yeah, you never, ever, ever hear that.
while term
Tax-free,
life
I'm like,
insurance is
Yeah, I got time, Gus.
While term life insurance is going to be covering, the life only over a certain period of time, say 10 years, 20
Okay.
years, for example, whole life insurance will cover the entirety of your lifetime, as long as you keep the policy in place.
Also more expensive, right?
It's just more expensive, but one of the reasons it's more expensive, it has a little bit more features. So you can have the accumulation and the ability to build up a cash balance inside of the policy as you're paying premiums over time. And to your point, taking withdrawals, you have the ability to take withdrawals in the form of loans, or withdrawal directly from the cash balance, directly from the cash policy, and it's generally tax free as long as you keep the policy intact. So yeah, you definitely have the ability, but I think first and foremost, if you're going to thinking about buying a whole life policy, make sure that you have a need for the death benefit the death benefit protection first and foremost. But to your point, yeah, you can take withdrawals unique to whole life, not to term, where you can take withdrawals or loans from the policy and tax free. Now you have to be careful. You don't trigger a taxable event when you're doing this, because if you withdraw or borrow more than the premium that you put into, in other words, your basis, your premiums that you're putting into it, and you let the policy lapse or surrender it, you just created and triggered a taxable event.
Whoa,
Yeah.
wow. Don't do that, people.
Yeah. So
Do not do that.
So pretty much,
now any withdrawals that you take from from the whole life policy are going to reduce the cash value, and it's going to reduce the death benefit that's eventually going to be paid to your beneficiary. You pay it back, those go back up, but yeah, it's important to note that if you do take those out, you're borrowing from the policy.
Absolutely.
And it's a tax-free now, stream of income. And the last point I want to make is that I mentioned surrendering the policy.
Okay.
So whenever you have a whole life policy, you want to make sure that you understand that there's a surrender schedule typically attached to this, where the insurance company is looking for a certain commitment from the policyholder to continue to pay premiums for a certain amount of time. And it could be any distance, but there's essentially a surrender charge or penalty, another way of putting it. that if you surrender the policy too soon, that may, take away from that cash balance as well.
So if you die, for example,
Mhm.
is that what you're talking about?
So if you had, let's put. I want to
No,
just
no,
kind
no,
of make
no,
it to
no,
where
no.
people understand what we're doing. So let's give it a basis. Let's say $100,000. You have $100,000 policy. You borrowed, maybe 40,000, right?
Yeah.
So now, if you were to die at that point, you only can be awarded the 60 that's
right.
remaining.
That's right.
Just for people, so they at least know what we mean when you borrow against it.
It's going to reduce it in some, every insurance company policy is going to be different, but it's going to reduce the cash value and it's going to reduce the death benefit in some capacity.
Got it. So, yeah, be careful. Hopefully you don't die.
You're gonna be worth more dead than alive. She's gonna love it.
Now, you can earn interest and dividends inside the cash balance of a whole life policy, and they're tax deferred, so there's tax advantages also to it. And of course, I mentioned the death benefit goes to the beneficiaries tax free as well. So yeah, that's basically breaking it down, what term versus whole, and how to take whole the whole life policy utilizing withdrawals and loans from it.
That's kind of scary to me personally. Does that sound like something you would ever
Nope.
indulge in?
Not interested. They can have it.
I mean, it you know what though? That no interest just sounds a little bit enticing.
That what?
No interest.
Uh-huh.
That sounds enticing to me.
Yeah, well, I mean, you have kids.
Yeah, no interest.
You know?
Like.
Yeah, and when
Yeah,
you're talking
kids and
about life
wife, so.
insurance, because they go, the death benefit can go to the beneficiary tax free. That's why they make great estate planning tools, and that's why whole life is utilized in a lot of estate planning.
Okay.
Yes.
So we have shop for cheaper services, or not cheaper, less expensive services.
Yes, definitely less
Right.
expensive services.
Contribute to your 401k, right? To the company match,
For sure.
right?
Build a savings.
Pay the lowest credit card debt you have, get that win first, and use that to help you pay the other
Or
ones,
the highest.
depending on how much it
Interest,
is,
right?
right?
Yeah,
And the
yeah,
highest
yeah,
interest
yeah.
one, right? Get you some life insurance, whole or term, right? You with me?
Yeah.
All right. What else you got? Any fees with that? Standard fees?
Yeah, there may be inside the policy there may be some fees. You're going to definitely look into. Each policy is going to be different. What a lot of times is with these policies you can add additional things like living benefits and riders. That's going down a whole nother avenue, but those things aren't free. The insurance company's not in the business, right, for charity. They're not non-for-profit. They're trying to make money as well with your money, and so those things cost and they have fees attached to them.
Speaking of fees, Mike, what kind of fees come with your services? And what's going on with the some of the fluff that are unexpected?
Yeah, I'm what they call fee-based. So so let's break down the different ways advisors can get paid, and I'll talk about how I get paid too.
Okay.
You can earn a commission. All right, that's the kind of through insurance companies. If you're selling an annuity or you're bringing a life insurance policy, the insurance companies will compensate the advisor through a way of a commission, and you can earn that commission as a trail. You can earn it up front. There's also, with investments, you can also mutual funds. There's I don't do this. This is kind of an old way of doing it, but transactional business. So a commission when someone is buying and selling something in an account, the advisor can be compensated that way.
Okay.
There is also fees that are paid directly from the clients to the advisor, and fees can come in a number of different ways. The most popular way is the asset under management model, and where there's a big advisor that I don't want to say any names, but they're always talking about
Hit the
how
button.
No names.
No names.
that's their only model. Is asset
El
under
Chapo.
management. And so the assets under management works like this. You have a bucket of money, you give an advisor to actively manage, or they might hire a third party to manage it, and they're charging you a percentage of the overall amount of the account.
Right.
So if the account goes up, they're making more money.
More money. It's almost like a commission based, like kind of.
Yeah, well, it's not a commission because it's not coming from a separate company. It's coming directly out of the. You'll see right on your statement, fees paid to the advisor, quarterly, usually taken out. And it's paid directly from the client to the advisor, in that sense. So the asset under management is one way. Now you can, the way lawyers are compensated is another way that advisors can be compensated. Let's say you have just a one-time project that you need help with. Maybe it's a financial plan you need to put in place and you don't want the help after that, any help afterwards. Or if it's, I got an inheritance, what do I do with this? Can you help me with this one-time deal? An advisor can charge a set fee, whatever that may be, whatever their, their market price is, like a lawyer, or you can have be kept on a retainer, so that you call your advisor at any time in the middle of the night and, make sure talk about money. So those are the different ways, and then I'm fee-based, and there's sometimes I utilize, when I do retirement planning, I'm utilizing the use of annuities, and I'm paid from the insurance company. Now, I'm independent, so I go shopping for the best, insurance company with the highly rated insurance company with the best, solution to bring it to the table. And then when I do investments, I can charge a fee, so I'm fee-based commission, and I can charge the asset under management fee. So that's how I do my services. Look, at the end of the day, there's no bad way. None of these ways of getting compensated are bad. But when you're meeting with a financial advisor, you want to make sure that they're open, transparent, and they help you understand the way that they're compensated, because it may affect the advice that they're giving you.
Absolutely.
And you want to make sure that they're also, more importantly, that they're giving you advice that's always in your best interest.
So on that note, what are some common pitfalls that you can encounter by having a financial advisor?
I would say if you're shopping around for advisors and you're meeting an advisor for the first time, and they're right away, before they even get to know you, before they want to understand your situation, they're bringing solutions to the table. I would be cautious with working with someone like that, because that's like a solution looking for a problem as opposed to an actual solution for your problem.
Absolutely, that's making sense right there.
How about that?
I compare it to, like, if you go to a physician or a doctor, and the first time that you're meeting with the physician, before they get to know your vitals, they know your medication history, your health history, and your overall health. They're like, "Yep, let's go to surgery. You're gonna pause.
Take some perks.
You're gonna want to look at a different second opinion." And I would apply that same principle, when you're looking for an
I went to a
advisor.
doctor like that before.
Yeah, he tried to give you some perks immediately, or what?
Exactly.
All right, so that works out.
I got one for you.
What you got?
All right. So, what's your investment philosophy? Like, what are some good stocks that we should choose today, like in today's climate?
That's a good one, right there.
Wow. Yes.
Yeah.
And do you
Individual
predict?
stocks,
Listen.
It's not something that I really do.
The only other thing about that, we're looking at some of the things that are going, which we're going to touch on, like, we're going to take a deep dive.
Let's get it.
I definitely want to know, like, with the current economic climate, right?
Yeah.
There's probably going to be some turmoil. So what are you thinking as far as what kind of stocks we should?
Yeah, so I don't really do individual stocks. I help retirees. My practice is primarily focused on working with pre-retirees and those that are retired now. And they're looking, they have a bucket of money, whether that's through a pension, whether that's through their savings in their 401k or 403b, or however way that they've been saving. They're looking to take this and supply themselves with an income stream that will last them for the rest of their life in retirement. And if anything is left over, of course, they can leave something to their heirs if that's possible. So the way that I like to structure a retirement plan is first utilizing, because, I don't really work with ultra wealthy people. A lot of blue collar workers. I work, guys that work with, the union workers that, so these are blue collar employees that have a certain amount of constrained investment bucket, and they want that to stretch out for as long as they can live. They don't want to run out of money. So we first utilize guaranteed income streams through Social Security, through pensions, and through annuities to guarantee an income stream. When I say guarantee, though, that are separate from the market, completely separate from the stock market or bond market or any other market for that matter.
Okay.
These guarantees are as good as the guarantor, right? And so an annuity is only going to be as good as the insurance claims paying ability of the insurance company that's making that guarantee. So we look for highly rated companies. that have a track record going all the way back to the 1800s. For Social Security, of course, the guarantee is backed up by Uncle Sam and the trust fund, Social Security Trust Fund. Apparently, there's problems with that.
Yeah, it's kind of sketchy.
Come on,
That's a whole other topic.
Especially with the Koreans coming.
But Social Security is absolutely, and it's not
It's a
the
Russian.
entire part of the, it's a piece of the puzzle for most people. And so, and then, pensions. Again, the guarantee is as good as the pension plan's ability to continue the claims paying abilities. And there have been pension plans that have gone under in the past. So
Wow.
that's scary.
Whoa.
Bethlehem Steel is one that
What?
brings, that comes to mind. And of course, that's backed up by what they call the PBGC,
Okay.
the Pension Benefit Guaranteed Corporation, which is not going to cover dollar for dollar if a pension plan goes under.
What?
Man, that's scary.
Yeah.
That's scary.
Yeah,
You work
yeah.
That kinda
your whole
sucks.
life, you stay at a job that you may not necessarily love, and for there to be no pension at the
Yeah.
end of the rainbow.
Thanks for your time.
What did we? Yeah, like,
Goodbye.
whoo.
Yeah. Reminds me of Enron. Remember Enron?
Yes,
Yeah.
I remember.
How they went-
that.
they went under?
They were belly up.
Yeah.
They destroyed.
and
Nobody even
then
died
in a
of
situation where the company employees had all of their retirement tied up in the
Into
company
the
stock.
company
Company,
stock.
right.
Yeah.
And company
The
stock
stock
can go to
tank.
zero. At least with the pension, you get the Pension Benefit Guaranteed Corporation is a somewhat of a safety net, and
Yeah.
it pays something and not.
More reliable than.
Yeah, but that's, but those are the guaranteed streams that we try to implement first and say, okay, let's cover a floor of your basic needs that can put food on the table during retirement, give you what you need, and put food on the table, keep the lights on, etc. Once we get that down, and you're like, all right, you can live off this. Obviously one of the risks is inflation over the long term. So inflation may eat away that income stream, because even though Social Security gives you cost of living adjustments, it might not keep the pace of the real inflation because we don't know. So what we do then is any extra money that they have in surplus outside of those, once we implement that income stream for retirement, then we can take on the risk for investment. And the idea of taking on the risk, we'll put it in a managed account and invest it, and it could be a collection of stocks and bonds and whatever. And but over time, the idea is that may grow, hopefully, right? And if with time, 10 years, 15 years down the road, if your guaranteed income streams aren't keeping pace with your cost of living, now you have your own kind of inflation head that you can spin off money from those investments and give yourself, a plan B increase. But you want to take on the appropriate risk, not with the income, but with what you have in the surplus of the account. So that's kind of how I structure my retirement plans for a lot of the people. Now, everyone is an individual situation, so that's not how I do every single one. It's always going to be tied to that, but that's a good idea of a good approach to how I try to do retirement planning with that strategy.
Okay.
What was your other question? It was
I got one.
yeah, the term.
I want to
we were
break.
talking about.
I want to break this in.
What you got?
I want to break this.
Come on,
in
Smoove. Bring it.
because I've been talking about this for probably about 2 years right now. I'm gonna give myself because I've been talking about this. The mainstream media has just now decided to address this issue that we're about to bring up, and
Scott.
many of you don't know about this issue. All right. And people have looked at me like I had two heads. Like, what are you talking about? Man, if you don't shut up. All of these things, this is when I was explaining this to people. I said, listen, man, the rest of the world really does not like us. And I name names. I said, hey, listen, you need to be looking at North
Right.
Korea.
Uh-huh.
They're like, okay, well, North Korea, right. They don't really have the weapons,
Right,
blah,
they're
blah, blah.
small,
Yeah.
yeah.
I'm like, China, man, we built China pretty much. Look at, just turn whatever is the closest thing that you have next to you, turn it upside down. It probably says,
Yeah.
made in China. We made that.
Everything.
We did that. We gave them that much power because we decided, and our own American companies. If you look at Apple, all their manufacturing, they turned it over to China. We outsource all of our work. We don't use our
Dude, because we're making money on OnlyFans and
yeah.
and
but guess-
YouTube. We don't need to make any. We're not gonna work hard putting stuff together.
We've
The
built.
Industrial Revolution was
Listen.
over, man.
Richard Nixon said, "Hey, you know what? Why do we need to be backed by gold?" Right?
Yeah,
Yeah,
Setting
and they
this up.
stopped it.
We've
Remember?
been setting this up for so long for this epic failure. We've been really working on this, and we never played nice with anybody. We want to throw sanctions on people whenever we want. We want to be the world police, and it looks like it's catching up to us a little bit. People are coming together against U.S. You have Russia, China. There's an alliance, right?
Right. Don't forget North Korea.
North Korea is
Right.
definitely in. They're not part of the official BRICS. I didn't want to mention
Right.
it yet.
Cuba.
But, you know, Brazil. Yeah, Cuba doesn't like. Even Mexico,
Right.
which is right underneath us. Which is they have shown interest.
They're
that
showing
they want to be
interest.
down, right?
India. Don't
India
forget
is definitely in there.
Brazil,
They're part of the BRICS.
Brazil.
is the B in the BRICS.
Saudi Arabia.
Yes. Now
Iran.
wait. That
Now
right
check
there,
this out. Remember,
that
Saudi
part right
Arabia
there.
and Iran have been at war
Yes.
since the
The
beginning.
Shiites and
And the other ones, what are the other ones
the
called?
ones.
It's just
They've been at war for decades.
it's like
Forever.
right.
Right.
And then here comes this
China to mediate peace.
out of nowhere. We've
Out
been
of
trying,
nowhere.
and we know both sides, right?
Yeah, out of nowhere. They just said, you know what,
Unbelievable,
we're gonna call for peace over here, and they were able to get that off.
Sunnis, it's the Sunnis.
Yes, the Sunnis,
Shiites.
Shiites.
I told you it was
Yeah.
in there somewhere. I just had to get it
so
out.
They were at war for as long as anyone can remember,
Right,
right?
right.
And China brokers peace, and
Now they're
the Middle
considering
East.
using the dollar.
They did peace in the Middle East. And who would have thought, right? We thinking that America would do it. Now look, guess what? So now they're saying, hey, Dig, check this out, man. How about you use this Chinese currency?
Yeah, what is it
over
called?
here
What's it
instead?
Yuan, renminbi.
No. Isn't it? Wang? Something like that.
Chinese currencies are renminbi or the yuan.
The yuan. It's
the
the yuan.
yuan,
That's
right.
what- I know how to spell it. I just can't say it.
YUAN.
YUAN,
Yeah, I
right?
can't
So they don't want to use it. They're thinking about not using
They're
it.
going to use it. They're going to use it, and I'm going to tell you why. Because they have enough protection between Russia and they're getting support from South Africa as well, right? And then there's other Asian countries who are just going to jump on because it's going to be a situation where it's like get down or lay down. Because everybody else is going to be using this currency for once. So when they decide to do that, what people don't understand is that the American dollar is so heavy. Why is the American dollar so heavy? Go ahead.
Oh, we just
Cuban
start-
Jay, what you got?
We start printing money like crazy.
We started printing money like crazy, and mainly we're using the American dollar for the exchange, right? That is the currency
Yes.
for Saudi Arabia to sell their oil. So you have to bring it to the dollar to bring it anywhere else. So if they take that out and replace it with the, what do you call it, Wang?
Yuan.
Yuan, okay, Yuan, which is the Chinese.
It's going to bring
version
inflation
of the
up
dollar.
in the United States.
Substantially. Not significantly, but drastically. Can we say drastically? I'm talking about like
Yeah, we can.
3x probably. This is just speculation. We don't know for sure.
No,
but
we don't.
It's going to be devastating. I can promise you that, and it will turn our economy upside down. So, we say that to say, what in the world could we possibly do to try to mitigate some of this? We can't stop it, right? But just locally, what can we do as responsible citizens financially?
Man, Michael just said it. Invest in the 401k. Get some life insurance. Pay your bills.
Don't worry about this stuff. Nah. Put your head down. Keep-
Don't
Find a
worry.
rich person.
Oh man, but
I'm single, ladies.
No, but I do think there is the point that this stuff is scary when you talk about it, and there's some of the times I have to tell myself and for other situations is control what you can control at the end of the day. A lot of
Yes.
this stuff is out of our control, these global economic issues that you're talking about here, and you could only control what you can control, and that is doing
point.
what you best, being the best person that you can be, being the best spouse that you can be, and and hope for the best, and that America's time as the king of the world is not coming to an end, but it's definitely something in the news to be worried about.
surely.
One of my friends asked me, changing the subject back to the relationships and money.
Got it.
Right? So if you're in a relationship and you have a high earner and a low earner, and the low earner wants to combine income,
Sheesh.
talk to me.
Why would they?
Tell me something.
Well, okay. All right. Let's keep it honest. In many cases, this happens, right? Typically, not always, but typically, the man might be the heavier earner. It's definitely changing right now, modern day. The last women are out educated, Now they're out educating us, right? And then some of them are now out earning us. There's a shift
for
going
sure.
on. For sure. There's definitely an economic shift there. But traditionally, it would be the man who would get the short end of the stick on that, right? For those of us who are old school, yeah. If you guys that are like Gen Z and below, you're probably going to be able to benefit from a higher earning woman. But outside of that, that's not what it was. And when you want to put your finances together, it's a scary thing, but it is what it is. What can you do? What would you do?
What would you do?
Pass that buck right up.
Yeah, that's a tough one.
It's scary, right?
Now,
Yeah, the times have changed though. You know, my grandfather was a union employee for GM in Wilmington, Delaware, and my grandmother didn't work at all, and that was
And it was enough.
time.
yeah, that was good though.
And completely different time. But then I think our generation's parents, you start incorporating, both the husband and wife, and or both spouses working and had to work, and that started in the 80s, I think, and definitely in the 90s, and today, it's tough. I mean, it's tough to raise a family today.
Oh yeah,
Yeah.
even with dual income.
Even with dual
What, how about even if you have one person that is not a good financial planner
Ooh.
and the other one is?
All right, now time out. Now,
That's okay, it works.
I'm gonna tell you something.
You
Well,
can't combine income on that.
listen. Well, let me tell you something. Well,
Is it me?
It's
Is
possible.
it me?
It's possible, right? But in that particular case, let's say that your wife or potential wife
Whoa.
were the breadwinner, hypothetically, right? And she was really good with her finances, and you sucked at it. What I would advise you to do, right, is to fall back and let her handle the situation.
Right.
Don't touch the money.
I'm not touching
what I
anything.
mean? And
Yeah.
vice versa. If you were the king and you getting what you get, that's fine. Whoever is bringing in the finances and manages it better. Whoever manages it better, you let them do that. When you become one, in my opinion, you kind of trade strengths. So
Yeah.
if this person is good at this person, then you let them do that, right?
right.
If your wife might be good at cleaning, right, or cooking, right? In your case, maybe.
Housekeeper does that. You know that.
Okay, so your wife might be good at something else that you like,
But-
right? Who knows?
Check.
You let her be great. You let her be great.
But
No.
but now check this out, guys. Right? Scenario: you have a wife that runs the bills. You come in, and you just pay everything off, and
Okay.
she comes back and does it again. You're doing the Michael plan, going into the 401k, paying your bills low to high, right? High to low, and they come in and it runs them again.
No.
You combine income then?
That's your fault because you're supposed to understand how your partner is financially before you get married. You don't marry a person who you have to test them. You have to vet people, right? And you see
Yeah.
how they do on their own as an individual before you even start that. If they are responsible and they're maintaining you, listen, you should know your fiance's credit score. Period.
FICA score too.
Yeah, so say credit score. Yeah.
Auto insurance score too. They got scores for everything now.
Yeah, I don't care about the auto insurance per se, but learn as much information as possible.
So would you
especially financial.
disqualify a girl if she
Yeah, absolutely.
has a low
Absolutely.
credit score?
Absolutely. Your chain.
I mean,
is
do you
only
really need her for
your
a credit
chain
score?
is only as strong as your weakest link.
Amen.
If your woman has access to your money,
Preach.
or if you're a lady and your man has access
Can
to
I
your
get a
money,
witness?
and he's bad financially, then absolutely you will be destroyed. You don't let anybody else destroy you. Men and women, if your partner is not nearly as responsible as you are financially, don't do it. Don't do it. You don't do it. You have to come to that type of agreement together because everything is together. You don't have a choice.
So you'll just keep the finances apart.
No, I just won't marry them because eventually
That's rough.
they're gonna no. Listen,
What if she's a great cook?
listen. Well, guess what? Let me tell you something. Well, you know what I say. As a man, what you're supposed to do is be good in every aspect, right? I know how to cook really well. Listen, and I'm going to be able to choose. If the more you improve yourself,
Yeah.
the more choices you will have.
Absolutely.
Improve yourself in every
Absolutely.
way.
That's right.
And
Control
if
what
you
you
have,
control,
yeah,
I
exactly.
like that. Control what you can control.
Yeah, we're gonna.
We should name the segment that.
Stealing that.
Control what you
At
can
least for the
control.
episode.
I
Control.
like that.
Control. So, if you yourself understand what you're worth because you've built your worth, you've invested in yourself, right?
I know
like,
it.
Like Mike just told you right here, right? Invest in yourself, right? Get yourself a good financial advisor.
Yeah,
like
this
him right
applies-
here, whose information will be in the description. right? Your finances would be right. Take care of your body. Make sure you are only putting the right things in your body. Work out.
I'll take care of their body.
Learn something. Read at least 10 pages of some type of material every single day.
Yeah.
If you can't, just start there. You can. Everybody has time to read 10 pages of
Read a
something
book.
every day. Get in a book. Learn something. Self-improvement. Get with all of that.
And treat your man like you treat your cell phone.
Yeah.
Touch him. Look at him all the time. Wake up in the middle of the night. Look at it. Bring it with you everywhere. Right? Can you imagine if women started to treat men like they treat their cell phones?
Oh, the population would be a lot higher. We'll say that. We can say that. Now, what I want to do, I want you to give all the information for the guys who may not be able to read the description or is ready with their phone, who's always had their phone in their hand and wants to just jump right in right now. Let everyone know where we could find you, what's your website, if you have the YouTube page, any social media, anything, and how people can reach you.
Yeah, well, I have a website, bellretirementstrategies.com. You can also just go to bellretirement.com. I own that URL also. And yeah, then you can give me a call at 610-989-2808. That goes direct to my business cell phone. And also can receive text messages on that, compliant approved text messages. And also just for, for the officially, just make sure that I, anytime I talk about investments today, all investment involves risk, including the potential loss of principal. There's no guarantee that any investment strategy will be successful, and past performance is no guarantee of future results. Just wanted to make sure that I said that for the record. And yeah, so you can get a hold of me. Yeah, you can call me, reaching out. Mike at bellretirement.com is my email. And any of those avenues that you want to reach out to me is definitely a way that you can.
Awesome. Hopefully you guys love the information out here today. We definitely got serious information. I feel like Mike Alderson.
Yeah, well, there was one other thing that I want to talk about.
We'll get ahead.
What you got, Mike? What you got?
So we were talking about what to invest in the end of days. Obviously a good bunker.
Oh yeah.
Work.
Good bunker. Okay.
Bucks County, back after World War II, they built a lot of houses with nuclear bunkers, ammunition. No, but all joking aside, I guess with the currency issue that you talked about, there are a lot of things. The bank situation that's going on right now, the bank failures is very scary. So there's always something to be scared about, and I think that, you definitely, should have caution, but also at the same time, if you plan for the end of the world, that's not the most ideal thing because none of us are going to make it out alive either. So I think you have to have a little bit of optimism sprinkled into some of the worries that are out there in the world. And with the currency issues, that I think a lot of people are bringing up, even with the bank failures and the currency issue, that gold bullion is a way to. And I just wanted to talk about gold a little bit. And when you compare gold to a traditional investment, it's lousy, right? It's lousy. It looks pretty, but it's a lousy investment. And when I say that, it's because you buy stocks to pay dividends. I pay you dividend. You buy bonds because they pay you a coupon yield, right? And you buy real estate because it can pay you rental income. Gold does none of those. But what it can do is, I guess why the gold bugs like it so much is that, for whatever reason, since going back to the early trades of human times of early trade,
back to
it was used
Templar.
as a monetary, it was used as a monetary, way of exchange. And so, even in 1944, when post-war war, when they were creating the next world reserve currency and the dollar became its place, in 1944, the Bretton Woods Agreement, we were backed by gold. The dollar was backed by gold. So I think that's the case for that. But when you're talking about, how to approach and what to invest in during, times that are scary, I think, it's no guarantee that a well-diversified portfolio will keep you from losing money, but it will definitely help you navigate these choppy seas, because you want to have a little bit of everything, all right? And I mean stocks, bonds, mutual funds that hold those things, real estate, whole life insurance that doesn't correlate with the market, you know, and even gold, and you know, I'm probably missing a few other things on the checklist. But my point is that diversification is your best, you know, way to go through some of these scary times, and it's not a guarantee because you may still lose, but it's a definitely a good way to navigate through, you know,
Yeah, so you're
navigate
hoping,
through the choppy waters.
right. So you're hoping when something goes down,
That's exactly
that
right.
there's something in your portfolio that goes up.
That's right.
And
You don't want
back
to
and
put all
forth.
your eggs in, you know,
Yeah,
one
one
type
bucks.
of
Yeah,
asset.
absolutely.
I'm an investment advisor representative of Equity Services Inc.
Oh, okay.
My
Awesome.
broker dealer and my RIA, corporate RIA, registered investment advisor.
So we appreciate everybody who came through tonight to join us. And like I said, please do drop a like. We know you liked it if you made it this far in the video, and we are sure tonight that we offered you some value. Thank you for joining us, because you could have been somewhere else becoming more stupefied maybe, but we offered a little value today. So thank you for dropping in. And as always, stay hungry, my friends. Never thirsty.